Imagine waking up tomorrow and finding a thick stack of envelopes in your mailbox. You already know what they are before you even open them. Bills, medical statements, tax notices, and right in the middle of that stack, a letter that makes your stomach drop. It is not another bill, it is a notice from the IRS. Turns out, you have been doing something wrong with your checking account for years, something that could cost you thousands of dollars you were supposed to keep for retirement. And the worst part? You did not even know you were doing it. Hi, I am Margaret, and this is your retirement reality check. If you are over 50 and relying on a checking account to manage your day-to-day money, you need to hear this, because the IRS just changed the rules on bank accounts, and most retirees are losing thousands without even knowing it. Today, I am going to show you exactly what is happening, why it matters, and 5 simple steps you can take right now to protect your hard-earned savings. This is not a scare tactic. This is about your money, your future, and making sure you keep every dollar you deserve. Let me break it down for you. The IRS has increased reporting requirements for all bank accounts, including checking accounts. That means your bank now has to tell the IRS about certain transactions you make. And if those transactions do not match up with what you report on your tax return, you could face penalties, fines, and even have money taken directly from your account. Most retirees I talk to have no idea this is happening. They just assume their checking account is a safe, simple place for their money. But the rules have changed, and what used to be innocent is now being watched very closely. Think about your own account for a second. Do you regularly write checks for large amounts? Do you transfer money between accounts? Do you keep a high balance? All of these activities can trigger IRS scrutiny under the new rules. And if you are like most retirees, you are probably doing at least one of these things without realizing it could cost you. This is not about cheating on taxes. This is about not knowing the new rules that did not exist when you were working. If this is making sense to you so far, do me a quick favor right now. Hit that subscribe button and turn on the bell notification. Every week, I break down another piece of the retirement puzzle so you can keep more of your money where it belongs. And while you are at it, give this video a thumbs up. It tells YouTube you find this information valuable, and it helps more retirees just like you find this channel. Now let us talk about why this problem is so widespread and so damaging. The new IRS rules are not just about catching tax cheats. They are about tracking every dollar that moves through the banking system. And retirees are getting caught in the crossfire for 3 main reasons. First, many retirees have simple finances. They are not used to tracking every transaction like a business would. Second, they often have multiple accounts, checking, savings, maybe a retirement account, and they do not realize these accounts are all being reported. Third, and most importantly, the rules are confusing, and the banks are not explaining them clearly. They just send you a form and hope you figure it out. Let me tell you about Bob. Bob is 72, a retired teacher from Ohio. He lived on a fixed income of Social Security and a small pension. For years, he used his checking account for everything, paying bills, groceries, even helping his grandkids with school supplies. Last year, he got a letter from the IRS saying he owed $3,700 in unreported income. Bob was shocked. He did not have any extra income. What he did have was a habit of transferring large sums from his savings to his checking to cover big purchases, like a new HVAC system. The IRS flagged those transfers as suspicious. Even though Bob could prove the money was his own, he still had to pay a tax preparer to sort it out, and he racked up some penalties. Bob lost money he could not afford to lose, all because he did not know the new rules. This is where most people get stuck. They think, I did not do anything wrong, so I have nothing to worry about. But that is not how the IRS sees it. The IRS sees transactions that do not match tax returns, and they automatically assume the worst. And once they start looking, it is hard to make them stop. The good news, there are specific protections and strategies that can keep you safe. That is what I am going to show you next. I want to hear from you. Drop a comment below and tell me, Have you ever gotten a notice from the IRS about your bank accounts, or are you worried about these new rules? Your story might help someone else who is going through the same thing right now. And if you have not already, hit that like button. It takes 2 seconds, and it helps more people like you find this video when they need it most. So, what exactly is the protection? It is called the Bank Secrecy Act, and it has been around for decades, but the IRS just got more power to enforce it, thanks to new funding and technology. The act requires banks to report certain transactions to the IRS, like cash deposits over $10,000, or any transaction that seems unusual. The key is understanding what triggers a report. For most retirees, the danger comes from three things: large transfers between accounts, consistent high balances, and frequent cash withdrawals. These are all normal activities for retirees, but they look suspicious to the IRS if they are not properly documented. Here is the simple way to think about it. The IRS wants to know where every dollar in your account came from and where it went. If you cannot prove it is your own money, say from a retirement account or a sale of property, they might treat it as unreported income. That is why you need to keep good records. Save every statement, every transfer slip, every receipt for big purchases. If you move money from savings to checking to buy a car, document that the money came from your IRA distribution or from the sale of your old car. Without that paper trail, the IRS can and will take the position that the money is taxable income. But there is something else. The banks themselves are now required to send you a new form called the 1099-C for certain cancellations of debt and a 1099-B for broker transactions. These forms are being sent for things that never used to be reported. For example, if you have a home equity line of credit and the bank forgives part of it, that is now reported. If you trade stocks in a non-retirement account, those trades are reported in more detail. The volume of forms is increasing, and mistakes happen. That is why you must check every single form you get from your bank. Compare it to your own records. If you see something that does not look right, call the bank immediately. Do not wait for the IRS to notice. Can I ask you something? Have you been paying any of these bills without realizing you did not have to? I want to know because your experience is going to help someone else in the comments. And if this information is clicking for you, I want you to do one thing real quick. Hit the like button. It takes 2 seconds, and it helps more people like you find this video when they need it most. Now let us talk about the traps and pitfalls. The biggest mistake I see retirees make is ignoring the notices they get from their bank. Those notices are not just routine updates. They are warnings that the IRS might be watching. Another trap is co-signing loans for family members. If you co-sign and the other person makes payments, those payments might be reported as income to you if the loan is forgiven. Yet another pitfall is using online payment services like Venmo or PayPal for large transactions. These platforms are also required to report to the IRS, and they often do not provide the same level of detail as a bank statement. Let me tell you about Linda. Linda is 68. A widow from Florida. She loved helping her grandchildren with college expenses. She would write checks from her checking account to their schools, sometimes for several $1,000s at a time. She also gave money to her daughter for a down payment on a house. Last spring, Linda got a letter from the IRS saying she owed gift tax on over $50,000. Linda was stunned. She thought gifts to family were tax-free, and she was right. Up to a point. The IRS allows you to give up to $15,000 per person per year without filing a gift tax return. But when you go over that amount, you have to file a form. Linda never filed those forms. She did not know she had to. Now she faces penalties and interest on top of the tax. Linda lost money she could have used for her own medical bills, all because she did not understand the rules. This is where most people get stuck. They think the IRS is only after big corporations or tax evaders. But the reality is, the IRS is under pressure to collect more revenue, and retirees are low-hanging fruit. They often cannot afford fancy tax attorneys, and they are less likely to fight back. That is why you must be proactive. Do not wait for a letter to start keeping records. Start today. If you found this helpful, make sure you subscribe, because next week we are going to dive even deeper into another strategy that can protect your retirement savings. And while you are at it, share this video with a friend who might be in the same boat. You never know, you might save them thousands. So, what can you do right now to protect yourself? Here are 5 concrete steps you can take today. First, get organized. Create a simple filing system for all your bank statements, transfer receipts, and tax forms. You do not need anything fancy. A shoebox or a folder on your computer will do. Just make sure everything is in one place. Second, review every form your bank sends you. That includes the 1099-INT, 1099-DIV, 1099-B, and any new forms like the 1099-C. Compare them to your own records. If you see a discrepancy, call the bank right away. Third, limit large cash transactions. If you need to move a lot of money, use a check or a wire transfer and keep a copy of the transaction. Fourth, be careful with gifts. If you give more than $15,000 to any one person in a year, file a gift tax return. It is easy to do, and it keeps the IRS off your back. Fifth, consider consolidating accounts. Having too many accounts can increase reporting and make it harder to keep track. Pick one main checking account and one savings account and try to keep the majority of your money there. These steps sound simple, but they can save you a fortune. The key is to start now, before the IRS comes knocking. And remember, you are not alone. I am here to help you navigate these confusing rules. If you know someone who needs to hear this today, do me a favor and share this video with them. It might be the most helpful thing you do for them all week. And if you have not already, please hit subscribe. I have so much more to share with you, and I do not want you to miss a single video. Now, let me walk you through a real-world example of how this works in practice. Meet Frank and Sarah, a retired couple from Arizona. Frank is 70, Sarah is 65. They have a comfortable retirement with Social Security, a pension, and some savings. But they like to travel, so they keep a high balance in their checking account to cover trips. Last year, they decided to buy a new RV. They took money from their savings and moved it to checking to pay for it. A few months later, they got a letter from the IRS asking about the large deposit. Frank and Sarah were smart. They had kept a detailed record showing the money came from their IRA distribution, which they had reported on their taxes. They sent a copy of the form to the IRS, along with a polite letter explaining the situation. The IRS closed the case with no penalties. Frank and Sarah protected their money because they had their paperwork in order. This is the power of being prepared. You do not have to be a tax expert. You just have to keep good records and respond quickly if the IRS comes calling. Frank and Sarah also took an extra step. They set up a separate savings account for big purchases, so they would not have to move large sums from savings to checking. That way, the checking account balance stayed consistent, and they avoided raising any red flags. If this is making sense to you so far, do me a quick favor right now. Hit that subscribe button and turn on the bell notification. Every week, I break down another piece of the retirement puzzle so you can keep more of your money where it belongs. And while you are at it, give this video a thumbs up. It tells YouTube you find this information valuable, and it helps more retirees just like you find this channel. Now, let us talk about some extended variations and special circumstances. What if you are divorced? The rules still apply, but you might have separate accounts, which can actually help by keeping transactions smaller. Just make sure you keep records of any support payments, as those can be deductible or taxable depending on your divorce agreement. What if you live in a community property state? That adds another layer, because income and accounts are often considered joint. In that case, be extra careful about large transactions and consider talking to a tax professional who knows your state laws. What if you have a small business? That is a whole different ballgame. Business accounts are under even more scrutiny, so you need to keep a strict separation between personal and business finances and use accounting software if possible. Another question I get a lot is, what about online banks? Online banks are great for many retirees. They often have lower fees and higher interest rates, but they are not exempt from the reporting rules. In fact, because all transactions are electronic, they might be even easier for the IRS to track. The same steps apply. Keep good records, watch for forms, and limit large transfers. One advantage of online banks is that they usually have excellent mobile apps that make it easy to export statements and track your money. Before we wrap up, if you have not already, please hit subscribe. I have so much more to share with you, and I do not want you to miss a single video. And if this information is clicking for you, I want you to do one thing real quick. Hit the like button. It takes 2 seconds, and it helps more people like you find this video when they need it most. So to recap, the 3 most important things you need to remember. First, the IRS is watching checking accounts more closely than ever. Second, you can protect yourself with simple record keeping. Third, act now. Do not wait for a notice to start getting organized. You hold the power here. You just need to know how to use it. Leave me a comment below and tell me which one of these protections you are going to look into first. I read every single comment, and I love hearing from you. And if you found value in this video, share it with a friend who needs this information. At the end of the day, a successful retirement is really just about keeping as much of your own hard-earned money in your own pocket as humanly possible. So go out there, make those phone calls, fill out that paperwork, and refuse to pay the bills you do not owe. Until next time, keep retiring smart.